All right, hi everybody, welcome back to another video in which we'll talk about 7 beaten down stocks that are trading at extreme valuations relative to their own history. So without further ado, let's get started. All right, hi everybody, welcome back to another video. I'm super stoked to record another solo video this time. The last, I think, 5 videos that I published on this channel were more in a podcast format. So we are back to more regular content. And the idea that I'm going to pursue in this video is to run sort of a magic formula screen. So what I did is I looked at my universe of quality stocks. I looked at my watch list. So I have a watch list of around 100 names which I consider quality businesses and that I would like to own at the right price. And I was looking at these stocks and looking for the companies that are trading at a very low valuation relative to their own 10-year valuation history. So that's a feature that Koifin provides. They call it percentile ranks. And basically you can screen or look for companies that are, for example, trading in the 5th percentile of their valuation history over a given time period. And let me just say that this approach was inspired by the Twitter user ValueStockGeek because he shared a similar approach on X the other day. And what he also highlighted is that the magic formula, of course, used to work in the past and it still does. But the magic formula consists of 2 components. We have the cheap factor, that's basically the valuation multiple the stocks are trading at. And then we've got the good company factor, which is the return on invested capital earned by these businesses. And some people have shown that the cheap factor is actually the more relevant one. So that's what I tried to do in my screen as well. I basically looked only at the cheap factor and looked at the cheapest stocks in my quality investing universe. And that doesn't per se mean that these businesses are actually cheap. It only means that they are optically cheap based on a valuation multiple basis. What I should also say is, before we jump into the first name here, is that this video is going to be more quantitative in nature. I haven't done a deep dive on all of the names that I will discuss today, and I can only touch the surface, highlight how cheap they are relative to their own history, give you a brief overview of what the business does, and it's then up to you to do the in-depth research required to actually start a position in one of these names. Okay, before we start, I have to say one more thing. So how did I measure a stock being cheap? I looked at the enterprise value to sales ratio. I used this metric as opposed to, say, a multiple that is based on actual profits, so an EBIT multiple or free cash flow multiple, because some companies sometimes go through a period where margins are depressed and you would want to bet on the margins recovering over time. So to get rid of this cyclicality, if you look at metrics on a last 12-month basis, well, I looked at the sales multiple here. And with that being said, we are going to look at the first name here. And what I will say is that in my watch list, I categorize the names by industry or sector or business model. And what I will also say is that most of the names that popped up here that were the cheapest relative to their own history were in the consumer basket, in the basket of consumer-facing businesses, brands, and so on and so forth. And I would argue that those are probably lower quality businesses, of course generalizing here, than many B2B businesses. So that's just something I wanted to get straight right away. The first stock is actually from my luxury basket, and this stock is Estee Lauder, which is trading in the 1 percentile, on the 1st percentile of its valuation history. Right now, the company is trading at an enterprise value to sales multiple of 2.5. So clearly, the stock is extremely cheap. However, as you can see on an EBIT made basis, so an operating income basis, the stock is actually not that cheap, which in a way reflects that this business is also experiencing margin headwinds, meaning it's much less profitable than it used to be in the past. And this is actually reflected in this chart here that I also included. As you can see, free cash flow margins as of today are below 10%, and they were as low as, I think, 4% in 2023, which is much lower than the historically generated margins closer to 20% by this business. So I would assume that most of you are familiar with the Estee Lauder company. It's basically a beauty company mainly focused on the skincare niche. To just read out what they actually do, the Estee Lauder companies manufactures, markets, and sells skincare, makeup, fragrance, and hair care products worldwide. It offers skincare products including moisturizers, serums, cleansers, toners, body care, and a bunch more. It's a huge company. They have 48,000 employees. They're headquartered in New York, founded in 1946. And what you can see on the right is that the business didn't really do well over the last 5 years. So as I just said, the business is facing margin pressures. Net income is actually down over 5 years. It has compounded a rate of negative 35%, which is of course pretty miserable. So I don't get excited about the Estee Lauder company. I don't know their brands well enough, quite frankly. There's probably an opportunity to turn things around to become more profitable again. But then again, I don't really know, and I'm not overly excited to do more work on the Estee Lauder company. So let me know what you think of this stock. Which brings me to the second stock that is trading at an extremely cheap multiple relative to its own valuation history. And this one is from my platform business bucket. And this one is Bumble. I'm sure, again, most people of you will be familiar with the business of Bumble. So Bumble provides online dating and social networking platforms in North America, Europe, and internationally. It owns and operates websites and applications that offers subscriptions and in-app purchases, dating products. The company operates apps, including, of course, Bumble, a dating app built with women at the center where women make the first move. Badoo, the web and mobile free-to-use dating app. Official app, never heard of this one, where users connect their profile with that of their partner, enabling a shared linked product experience, and a bunch more. So Bumble, as of today, really seems to be trading at a relatively cheap multiple. So we are looking at the 6th percentile rank here. It's trading at an enterprise to sales multiple of 1.7. and an enterprise value to EBIT multiple of around 11, which is almost a 10% yield. Compared to the Estee Lauder company, obviously Bumble is a much smaller company with around 1,200 employees. It's much younger too, being founded in 2006, and it's much smaller on a market cap basis too. So the market cap is only, quote unquote, only 1.2 billion US dollars. If we actually look at the numbers here and take a look at the numbers ever since Bumble went public. So as I said, we're looking for companies trading at a cheap multiple relative to their own 10-year history. Bumble hasn't really been public for that long. So they IPO'd, I guess, in 2021. So we only have around 5 years of data to look at. Over these 5 years, however, revenue has been trending upward. It rose from around, say, 550 million US dollars to almost double that today. However, as you can also see over the more recent quarters, revenue has stopped growing. And the margin has also come a little bit under pressure, but we're still looking at 17% free cash flow margins and around 12% EBIT margins. So I don't know. In fact, on an EBIT basis, that's what I just see here, the company is turning more and more profitable over the more recent quarters. So that might be a name I would actually be interested in doing some more work in. And generally speaking, I'm not overly excited about owning a dating app business just because I think their business model is fundamentally not the best, because basically what the apps should attempt to do is to match you with a partner, which would result in you losing a customer. So I don't think the incentives are really aligned here, because as a business, you want to have, or you want to create a high lifetime customer value, which you cannot do if you are successful in matching your customer with another customer. In fact, you will lose two customers at once. So I'm not sure if that business model isn't structurally a little bit broke. Which brings me to the third stock I wanted to talk about here. And this stock is from my serial acquirers bucket. I actually tweeted the other day, in fact today, about another metric that I recently started looking at. It's the rule of X. I'm not going to get to the details of it right here. If you want me to do a video on it, let me know. But I was also looking at my quality stock universe based on this metric. And what I noticed is that most of the companies scoring very highly on that metric were actually from the serial acquirers basket. So that's definitely a super high quality business model category, so to speak. And one name from that basket popped up in my screen here. I'm sure most of you will have never heard of this company. This is a company I actually looked at more recently. It's called Zigexn. I don't know if that's how you pronounce it, but this company is from Japan. That's why most of you will probably have never heard of it. It's also pretty much exclusively operating in Japan too. And this company is right now trading at an EV to sales multiple of 1.4, representing the first percentile rank for this particular business. So again, you can see it in the chart right here. This company is extremely cheap relative to its own 10-year history. On an EBIT basis, but I will say that the business is probably over-earning a little bit in terms of EBIT margin. I think the more recent EBIT margins were close to 30%. And I think that's what management is aiming for long term. But I think on a normalized basis, you're more looking at like a low 20s EBIT margin business here. But on an EBIT basis, the company is actually only trading at a multiple of 5.7, which at least seems extremely cheap. So what does Zigexn actually do? It operates the live service platform worldwide. It operates, I guess you can just pause the video and take a look at the description here. Put it in a nutshell, because I looked at this name not too long ago. They have 3 different segments. They operate in the HR space, so human resources. They operate in the real estate segment, and then they have another segment focused on more leisure activities like traveling. And they basically, for the most part, offer websites which can be considered demand aggregators. And they have this matching technology which should match demand and supply in these different fields. The difficulty I have with this business is that as someone not living in Japan, you have a really hard time understanding the unique selling point of the different assets they own. So there's that. And as I don't want to get into too many details here, I think I'll leave it with that and take a look at the next name. Now we look at the aforementioned consumer-facing businesses basket in my quality stock universe. And 4 names appeared in that list. First, we've got Diageo. We covered Diageo on this channel in the past. I think I did one solo video on this name, and I also did the alcohol beverage industry video with Andrew, where we talked about this industry, its challenges, and the valuations you find in this industry for around an hour. So as you can see, Diageo also is trading at a cheap multiple relative to its own 10-year history. Its percentile rank is 4%, and it's trading at an EV to EBIT multiple of around 16 and an enterprise value to sales multiple of 4.6. So if you want to learn more about this, I would recommend you check out the alcoholic beverage industry video we did, in which we covered all of the brands owned by Diageo, for example, their mode, which is arguably, besides brand, their global distribution and this enabling them to acquire companies at a higher price than competitors could do. It's a huge company. It's a market cap. It's trading at a market cap of around $69 billion. It has more than 100 years of business history and 30,000 employees. And it's headquartered in Europe, by the way. Speaking of alcohol stocks, another name we covered in our video on this industry is the Boston Beer Company. And I don't know all too much about the Boston Beer Company. I know that Andrew is extremely familiar with that name. So if you want us to do another video on this particular business, well, let us know in the comments, and we might record one on this business as well. This one, again, its percentile rank is 0%, so it hasn't been this cheap ever over the last 10 years. It's trading at an EV to sales multiple of 1.3 and an EV to EBIT multiple of around 15 to 16. As this chart here shows, over the more recent quarters, so basically over the last 2 years or so, the company, however, wasn't able to increase revenue, to increase its top line. So I'm not all too sure about that. Free cash flow margin seems to be trading at a pretty normal level. However, I would also assume that the bull thesis would be that the business will able to produce higher margins than the around 8.5% it produced over the last 12 months. And then we got two more names to cover here. The 6th name is Dollar General, which is basically a discount retailer operating in the US, which some consider basically a monopoly when it comes to discount retailers in rural areas. Again, I don't know all too much about Dollar General and their business and their unique value proposition, because I don't live in the US. So let me know what you think of Dollar General and whether their business model is still working nowadays. There are people claiming that the pandemic changed consumers' behavior. More people order stuff from Amazon, for example, and this is reflected in the margin profile of Dollar General as well, which has come under pressure. So over the last 12 months, the free cash flow margin was only around 4%. Of course, this is generally not going to be a high margin business. That's not their business model. But historically, they have definitely produced higher margins, almost twice as high. And I guess, again, the bull thesis would have to be that margins return more to this higher level again. Just to give some context here. So another business behemoth, basically, we're looking at a company that is employing 185,000 people. It's trading at a market cap of 16 billion. And as you can see here as well, net income has actually been shrinking over the last 5 years, whereas sales, so revenue, has been growing at a compounded rate of 8% over the last 5 years, which again, if you compare these two metrics, reflects that the margins have come under pressure, and it's up to you to decide. That's where the qualitative judgment comes into play, whether the margin profile can get more attractive again. And then finally, we have one more name that, again, I guess that's one of the lesser known names in the investing world as well. Again, it's a big business, so many of you might be familiar with the business. It's a company called Fevertree, a British company. Basically, it engages in the development and sale of premium mixed drinks. So another name that is sort of related to the alcoholic beverage industry, which shows that this sector or this industry is definitely not receiving a lot of love from investors. Its revenue has also been flat over the more recent quarters, but again, if we look at the long-term chart here, we see a pretty consistent uptrend. So back in 2018, the company was generating around, I guess, 180 million in US dollars in revenues, which is double that today. We're looking at a company that is producing 360, that's British pounds. Sorry, I said US dollars a second ago, British pounds in revenue today. But again, if you look at that sort of yellow line that is reflecting the operating profit margin of this business, we see a pretty steady decline of that EBIT margin, which again would be something that would worry me and I would be required to understand what is the driving factor behind this suboptimal development. Okay, and that should already be it. As I said, I can only touch the surface here. This video is purely quantitative in nature. I definitely didn't do any qualitative work on most of these names. And let me know which company you liked most, you would be interested in most, and maybe you would want me to do a more in-depth, quality-focused video on. Take care.